Hey everyone, today is November 5th. I think it's November 5th. It's November 5th, 2021. And today we are going to be talking about a whole bunch of interesting things that happened this week in the markets. The Fed kind of announced their tapering schedule for, getting back to maybe having rates above 0%, but there's a catch as always. We had a lot of interesting news from individual companies this week. We had this news of a new COVID pill. We talked about last week this one from Merck, but now there's an even bigger and better one coming from Pfizer that apparently has about 89% efficacy in preventing fatalities from those who have serious hospitalizations from COVID, which is positive news all around. But we're seeing a lot of interesting developments in individual companies, some of which have done really well through this pandemic, seeing the motors of their momentum kind of shift around as we're moving to perhaps a post-pandemic economy. But the main topic of this video for this week that I really want to talk about has to do with housing affordability, and it's a two-pronged story. It's about how housing has two different ways of valuing itself. And that is the utility value of a property, which is, what the material of the housing is, the value of the land because it's near something convenient or not convenient, and then the monetary premium attached to housing, which is how much somebody is willing to pay for a house in a certain area because they see it as a store of value, somewhere where they can park cash, which they know is losing value by just staying in cash. As we know, when it comes to housing, when rates are really, really high, there's no point in investing all your money in the housing market because you can just stuff it in a savings account and get a really nice fat interest rate, or you can buy a bond or something like that. So we know that as rates go up, usually the housing markets cool down, and as rates go down, usually the housing market heats up. Today, we're going to talk about a paradigm shift in how this might change in the future, because there's this fear that we might never return to a really high or positive rate environment ever again, that we might have close to 0% rates at all times because the government themselves have so much debt to pay off that if the rates go up, they're going to be in a bit of a bind. So there's an incentive for everyone to keep the rates low as long as possible, which probably helps to make housing affordability further and further out of reach for more people as time goes on. Today, I want to talk a little bit about how Bitcoin could potentially be a solution to this. And it's a little bit complex and confangled, but if you've been watching my show for a while, you know I'm a big Bitcoin advocate, and that I believe that a lot of money has not come into the Bitcoin space that are right now in assets that are, yielding negative percent or have other risk factors that Bitcoin can handle or do better with. So we're going to dive into it, starting with the first story, which is really quick, just talking about Zillow. So Zillow is a company in the United States. They buy and help sell houses. They're kind of like an online brokerage for housing. I think they are in Canada too. I'm not entirely sure. But they had a component of their business which was they would take their own capital, they would find houses on the market that were cheap, put in an offer, buy them, and then try and flip them. Sometimes they would renovate them, but usually they would buy a house with the sole intention of selling it within 100 days. And so they started this thing called offers, and that was basically a program which, again, they would go out and they would kind of go buy houses in neighborhoods and then try and flip them for more and turn a profit. There's a few businesses that do that. Another one of these is called Open Door. I don't know if Redfin does it as well, but it's a side business of some of these real estate brokerage, online companies. And this entire unit has collapsed as of this week, as was discussed in the Zillow earnings call. So Zillow, the digital real estate company, said on Tuesday that it's exiting offers, its business that buys and flips homes, and eliminating 25% of its workforce. We've determined the unpredictability in forecasting home prices far exceeds what we anticipated, Zillow CEO Rich Barton said in the release. Continuing to scale Zillow offers would result in too much earnings and balance sheet volatility. Revenue in Zillow's offer business, which competes with Opendoor, climbed to $1.17 billion in the quarter. That's way up from $186 million a year earlier, which was in the middle of the pandemic and a dry period for transactions. However, the home segment, which is mostly offers, lost $422 million in the quarter, producing an overall net loss for the company. So Zillow lost, I think, in that whole transaction in the last quarter, they lost more money in the last quarter through their unsuccessful home flipping than they actually made in profit for the entirety of this year so far. And so because of that, they're shutting down their unit. They're not going super deep into this home flipping anymore. And so one of the lessons from this we'll get to kind of later, but it's again this idea of monetary premium on homes. Now you have not only individuals competing to buy homes, but you have these big corporations and now these these online companies trying to flip homes as well. Um, the second story we're going to talk about is the Federal Reserve. Really quick, this was a story that popped up this week. People wanted to know what's next for the bond market, what's next for rates. And so the Fed has kind of come out, Jerome Powell has kind of come out and said, look, we still think that inflation is transitory. It's not here forever. We think it's mostly being caused by this supply chain crunch, and that even though times might be tough right now, we think it's going to ease back down. And so what they've also announced is, despite that, we still think that the economy is recovering quite well, and we're going to ease the purchase of our bonds, mortgage-backed securities, and treasuries. However, I think a lot of people expected that they would start off at a bit of a higher level with their easing of the bond purchases, yes. They said that they would do about, I think, 5 billion here. They would cut back by about 5 billion in mortgage-backed securities and about 10 billion of treasuries per month. And they said that they would perhaps change the rate at which they do that just based on the economic outlook. But when it came to rates, they basically said, look, we still don't think we're going to hit full employment anytime soon. And that is kind of the checkbox that we need to tick off in order to start raising rates again. One of the things I find really funny about this is there were a ton of stories this week about airlines and various other companies coming out and saying, if you are not vaccinated, you're fired. And so this kind of flies in the face of the Fed mandate as well, which is like if the governments are going out and they're telling people that, you're going to be fired if you, don't get the vaccine, then the question is going to be, well, how do you ever get back to full employment? Where are those people going to go? Are they going to go to jobs which don't require the vaccine mandate? Are they going to end up getting the vaccine no matter what? We don't know what happens to the cohort of workers that do not have the vaccine mandate. It's 10% or so right now, but I imagine eventually we'll finally kind of figure out what is going to happen to those workers and if they are going to be entering the workforce again really quick. Are they eligible for EI? That's not clear depending on what state you're in. But the mandate of getting everyone back to work is a little bit incongruent with the mandate of not letting people work if they haven't had the vaccine yet. And that segues into the next story, which is vaccines are great and all, but we are moving into therapeutic territory. So we talked about Merck's drug last week, and we had a surprise this morning of Pfizer's drug coming out and being 89% effective as a treatment against people suffering hospitalization from COVID-19. And so, prevention is always really important when you're dealing with a pandemic or an influenza, but therapeutics basically ensure that no one has to die from, or many fewer people have to die from COVID-19. Now, we don't know what the cost of these drugs are, but the story is basically that Pfizer has basically created this antiviral treatment, and they had a test case of about 1,219 adults. They were going to recruit up to 3,000, but they found that in the two groups, you have the placebo group and the non-placebo group, everyone who was seriously hospitalized with COVID-19 who had taken this drug did not die, and the 10 people who were given the placebo did end up dying. And so they're working on probably doing a larger scale experiment at some point, but they're passing this information onto the FDA. Very similar to Merck, which has put out a similar treatment called molnupiravir, which is only around 50% efficacy. My only question on this, and I'm not a big statistics person, is that it doesn't seem like that big of a sample size is, really a great way to tell if that's, that great. But, you can extrapolate these things to 10 times as many, and sometimes they're the same. I imagine that they know more about statistics than I do, but yeah, it is what it is. Also, I don't know if the hospitalization data is specific to people with the Delta variant. I imagine probably, since the Delta variant is kind of the predominant variant now in the States, but it could have changed. So yeah, some positive news on the COVID front. But yeah, it feels like we get closer and closer, to solving this thing, and then all of a sudden there's a new variant, and then we get set back 2 steps. So it's like 3 steps forward, 2 steps back. But I think the rise of therapeutics over the last few days and weeks from these various companies has kind of marked a shift in how serious that we view the pandemic, because now we have 2 angles of fighting it, which is both vaccines and therapeutics. If we're able to scale these things to mass production, if the costs are reasonable, then there should be very, very few people dying from COVID very soon. If we can get death rates down to 0, I imagine it's going to be very hard for people to keep things shut down or locked down or force mask mandates anymore. But who knows? I've been surprised this whole last year. Things have been very surprising. So, the feature story of today, we're going to talk about the monetary premium of just about everything. But we're going to focus it a little bit on housing because that's what people are most anxious about these days. Housing getting so unaffordable. Housing prices in Vancouver going up 15-16% a year, which basically means if you are not getting a 15% raise on your income every single year, then you are never going to be able to afford a house. You're going to have to maybe get a mortgage, and that's that, but you will never be able to outright own a house because it is what it is. Housing prices just go further and further out of reach. And I imagine if we have any market instability, the amount that they will let you leverage up a house gets lower and lower. We know that after the financial crisis, you used to be able to get a mortgage anywhere in Canada with like 2 or 5% down. And now, maybe pre-sale things, but for the most part, you need to have about 15 to 20% down or at least 10% bare minimum. So the collateral requirements have definitely changed. But we're going to talk about how Bitcoin could potentially change the way that we look at housing. And how I see this playing out is through an image that someone named Jason Lowry made here, and I shared it a little bit earlier. But it's about how all assets that we currently have right now, whether it be housing or gold or oil or equities, they're all defended by a monetary premium. And that monetary premium is how we defend them with human lives. And so this is kind of how he explains it in his image. Every one of these assets carries a monetary premium that we defend with human lives. They're protected and defended by military and rule of law. So our property rights only exist insofar that we have a country that will protect if anyone tries to take our property away from us. We have military, we have rule of law, we have international agreements. The value of land, the sanctity of property rights is contingent on our governments kind of upholding them. And the same goes for things like gold. Having police, having military, it gives our gold a bit more value because we know that it's protected by someone. We're not having to pay them directly. Maybe we pay it through taxes, but in a society, the strength of society gives a monetary premium to things. Same goes for natural resources like oil, and same goes for companies and equities. What makes Bitcoin a little bit different is Bitcoin does not need a government to defend it. So the Bitcoin network works not because the government is protecting your ledger kit. It's not protecting the internet per se. The Bitcoin network works because there's electricity decentralized all over the world that basically mines Bitcoin and keeps the Bitcoin network honest and truthful. And as long as there's kind of this international agreement upon the sovereign parties that mine Bitcoin and uphold the Bitcoin network will never be cracked. And it will never be taken down by a government, because one government can say we're banning Bitcoin, and then there will be governments that are accommodative all over the world. And as time goes on, governments are increasingly more accommodative of Bitcoin. They're not going to interfere. Unless there's a coordinated crackdown by every single government on planet Earth against Bitcoin, Bitcoin itself will likely not collapse. And likewise, I don't want to say that there is no chain of custody with Bitcoin. I think it's important to recognize that a lot of the mining operations can only exist because of property rights, because of the miners that exist on the property. But the point is this, that by transposing the monetary premiums of Bitcoin into cyberspace, using a digital synthetic commodity called Satoshis, we can replace the cost of human life with the cost of an electric bill for defending our wealth. And that is just the key differentiator between Bitcoin and every other asset. Every other asset on Earth primarily needs military power to back up its rights and its utility. We have to have people coming in and defending our ownership of things in order for them to retain their value and for us to know that they really are ours. When it comes to Bitcoin, we don't need to trust these governments. We don't need to trust any central party. We have a complete distribution recognition of this asset worldwide, and it's solely backed up by electricity. The work that is being done, that is put into the Bitcoin blockchain, is what gives it value and what protects it and what has helped it grow to $1 trillion asset class. And so lastly, in this image, the point is that not having to waste human life to defend monetized wealth, not having to go to war to steal the oil, to steal the gold, to protect companies, to destroy other companies, to protect land rights or to take away other land rights, by not having to waste any human life for the Bitcoin network to succeed, and by any of this violence to actually make that much of a difference on the Bitcoin network, That makes it a very unique asset. And in my opinion, this whole argument about is it good for the environment or not is moot, because not having to waste human life to defend monetized wealth is worth every watt. Okay, so let's talk a little bit about housing, because housing gets its value from two things. We talked about how in the image here, there's monetary premium, the way that things are defended through, bloodshed and history and a chain of custody. And then we have utility value, because if it was all just speculative, no one would care to own houses and they would just treat them like Shiba Inu coins. But there's a utility value and there's an intrinsic value to houses. And that intrinsic value is a couple things. It can be the materials that the house is made out of. It can be, where the house is located. Housing in a safer neighborhood is worth a lot more than housing in an unsafe neighborhood. It can have to do with the land. If the land has arable qualities, like it's in a good climate zone where you can grow things and you can produce an income from it. If the soil is good, if the terrain, if the land isn't just like a rock in the middle of the ocean, if it's actually a nice flat terrain, there's a lot of value, and people value things based on different things, and these different conceptions can change. Of course, things like waterfront property as well, really a big deal, might not be so sexy when we have floods and tsunamis, right? So it depends where you are, but land does have kind of this intrinsic value. And going a bit further, the home itself can have value. It can be from the materials it's made out of. Is a house made out of long duration materials? Then maybe I'm willing to pay a little bit more for it today, knowing that it's going to last long into the future. And then there's appliances as well, the stuff within the house, and then there's the layout, convenience, size, and things like that as well. So in addition to that utility value, which it's really hard to tell, how much is a house worth, how much is actual utility value, and how much is this premium that people are willing to pay in this crazy real estate environment, it's hard to come up of a number of it's 60% utility, 40% monetary premium. Who knows? But people have a general feeling about it. And that general feeling, is that housing, especially in some of these gigantic cities like Vancouver or San Francisco, have a much higher monetary premium than houses out on the prairie or a farm in the middle of America or in Canada. So some of the things that cause monetary premium are growth. So investors are chasing higher and higher yields. If real estate looks attractive and more attractive than bonds or savings or any of that, people who usually have typical allocations in those things are going to say, look, maybe instead of buying my seventh bond in my multi-million-dollar portfolio, we're going to buy some more housing instead, right? So there's growth begets growth. If the yields are low, generally housing does better because people just look at it as a better way of gaining money and getting appreciation. Ease of ownership as well. So if real estate is easy to own for people as a store of value and maybe a way to hide their wealth or to mask their wealth, or maybe it's just a convenient owning mechanism, right? You can just buy a house in a foreign country, rent it out, get a little bit of cash flow, not have to worry about it too much, and then, maybe a bank somewhere can't get you for it based on the taxes, then there's some value in that as well, and that adds to the monetary premium. There's the chain of custody as well. There is a certain aspect to houses that have changed hands quite a bit, which are kind of desirable. So investors like Zillow will look at a house and say, look, if this house is sold a couple times in the last few years, we know that it's desirable, that multiple people have paid an increasing amount of money for this house due to whatever factors, and they're willing to sit through and purchase these houses for premiums that are way above market just because the houses have changed hands every 100 days or so. If you have a house that's just sat on the market with a terrible history of selling or maybe selling below par, you don't buy it. And if you've ever been a home buyer before, you always look at the sales history to try and see, did the previous investors make any money on it? Am I getting a good deal based on, what the appraised value is versus the last sale value? Things like that. So that's a monetary premium aspect as well. And then many buyers, of course, are not actually interested in using the home for its utility value, and that adds to the monetary value as well. So there's the iBuying aspect of it. You have these companies that are using algorithms to try and figure out if a company is worth anything, and these companies drive up the cost of housing. You have the store of value mechanism, which is like, look, maybe it's a good inflation hedge, or I just don't want to be in a low yielding or a negative bond, and so housing makes sense to me, and maybe it's also really accessible because I can use leverage to purchase it. And then you have tax evasion as well, which is, some people can buy houses in other countries and not pay any housing tax on them. So you can own these things and you don't have to worry about financing them all the time. And maybe they're in a safe country, and things like cash flow too. So housing can be really attractive from a monetary premium standpoint. You might get no utility out of it whatsoever. You might never live in it. And there's thousands and millions of houses, I imagine, all over the world where the owners have never stepped foot in them. And it's because of their monetary premium. Now, the question is, can Bitcoin erode this monetary premium? And this article argues that yes, it can, but we have no cohesive evidence right now that Bitcoin can take value out of real estate. Yet, there is a really good case study that Bitcoin can steal store of value from another asset. And my case, and I've been trying to tell this to people that are into gold, is that Bitcoin is eating gold's lunch. And now that's not to say that gold is worthless. I also believe that gold has a utility value. It's used in electronics, it's jewelry, there's kind of a historic quality to gold, but there are facts, and we'll present them here, that a lot of gold's value is used in investments and it's held by governments to back up things like currencies. And both of those things are not necessary when we have Bitcoin. It is not necessary to have gold as an investment. It is not mandatory. Nobody requires it, as is today. Countries with currencies, if they want to change their laws and not have them be backed by gold, they're free to do that as well. And so those two aspects that are variables can be changed very quickly if it's made evident that Bitcoin is a better standard to move to. So one of the articles I like to prove my point on this, because a lot of people think of Bitcoin as this dollar denominated thing, but what I find really interesting with Bitcoin is you can also use it to see how have other assets done in comparison to Bitcoin. And MicroStrategy, Michael Saylor, CEO of this company, has put together a Bitcoin strategy document that lets you compare every one of the top 500 stocks, every one of the bonds, every one of the metals, or just gold and silver, indexes, and other currencies against Bitcoin to see what has their return been against it. So, point in practice, gold. Two things. It has lost 76% of its value to Bitcoin in the last 12 months. It has lost 11% in the last month. And of course, when Bitcoin goes up and gold doesn't go up as much, negative versus Bitcoin. And in the last 5 years, 98%. I was around when one Bitcoin was cheaper than an ounce of gold. And now one Bitcoin can buy you many, many ounces of gold. It might even be able to buy you one of those big fat gold bars one day if we're going to stay on the current trajectory. The other thing to really take note of here is it's not just like Bitcoin has outperformed gold, it's done better than gold, but it's the fact that gold has actually done poorly over the last year or 2 years. It's actually down 7% this year. And this is in an environment where the S&P 500 is up 24% for the year. I think the QQQ is up 30% for the year. So the average investor, if they are just in the indexes, is up 25 to 30%. If you were all in gold, you lost money. And that is hard because you're losing money if you're in cash right now. But if you're also losing money in an asset, pretty bad times for you out there, I will say. So, it begs the question, why is gold so weak? Well, we can say the simple answer is because Bitcoin is here and it's eating everyone's lunch. Maybe there's a bit of truth to it. But let's dive in a little bit deeper here. So, gold, distribution of gold demand in 2020. And this is by Statista. I don't know how accurate this is, but I tend to believe it. It looks like that breakup is pretty good. We have 46% of gold's value is in investment. People hold it as either a raw asset or an ETF or something in their portfolios. Here's the thing, is most people don't actually hold themselves physical gold. So a lot of these people who are investing in gold, they're buying gold futures or they're buying gold ETFs. So there's a middleman behind every single one of these things. And when you have middlemen overtop the price of gold, what they do is they hedge through things like futures, and they make money when the gold price goes up and they make money when the gold price goes down because they take a chunk out of it and they take a chunk out of the premium no matter what it is. 36% is jewelry. And you could argue that there's a monetary premium in jewelry. Some people will buy gold jewelry just to have gold jewelry, not because they necessarily need it or it needs to function for something. Some people will just buy jewelry and keep it around and then just plan on selling it later on. That is kind of a speculation. That's what I would call a monetary premium as well. Central banks own some. And again, like we said, that isn't mandatory. That can be changed. It's a variable at any time that can be changed. And then technology, that's something where gold is pretty essential. Now, some people say, gold can be replaced in some of these electronics, but gold is used in electronics every year. And this is the most deflationary aspect of gold because the gold used in electronics generally does not get salvaged. Only about 15% of the gold in electronics gets salvaged. And so, between that and gold still being pretty hard to mine, I would say it's close to deflationary as well, similar to Bitcoin. But here's the truth. Gold is down 15%, and if inflation is over 3%, gold usually, my bad here. I skipped one little thing here. gold has a correlation with inflation, and this is something that I wanted to bring up because something in the chain of usual events has been broken when it comes to gold, and that is that usually when there is high inflation and persistent inflation, gold will perform about 15% per year. Now, we have had above 3% inflation, I believe, for close to a year now, maybe about 9 months, and gold has underperformed in those 9 months. So typically, if inflation stays above where it is right now, gold will be going up about 15% per year. It is gone the other way. It is down negative 7% for the year. But you can see historically, especially when interest rates and inflation was really rampant back in the 70s and 80s, gold did tremendously. Paul Tudor Jones, Stan Druckenmiller, a lot of these guys made out like bandits when inflation was really high and gold did well. And you can kind of see that in the charts here. When inflation was high in 2005, gold went up, but actually you can see a bit of an inverse correlation. When inflation went down, and that's just because of the depression of housing prices, gold ripped as well. And so some people might argue, well, maybe gold does really much better in a deflationary environment. And we have yet to see that, obviously, for a very, very long time. But the statistic that stands for the most part and is generally accepted among most people is that if the price of everything is going up, gold will usually go up as well. So the other thing to mention about gold is that a lot of investors move to gold because it is able to store value, and it's because they can't get a yield on other assets. So, a gold investor might be a typical bond investor. A gold investor might be seen as someone who's very safe and protective of their money. And so they might be buying bonds, they might be buying, value businesses with dividends that pay out really well. And these things still exist today, but it's a little bit trickier to find them. So it's hard to find good yielding bonds. It's hard to find a company that is giving out dividends that is also still appreciating in value as much as some of these growth companies that makes just the dividend itself worth it. One of the differences, though, is that Bitcoin is much more fungible in terms of a digital property than gold is. And so one of the attractive things about Bitcoin is you can get a yield on it. And it's not to say that you cannot get a yield on gold. You can lend your gold out and maybe get a couple percent a year on it, but it is extremely easy to buy Bitcoin and lend it out to a third party and get a yield. Some of these third parties are insured custodially, so you don't even have to worry that much about lending it out. But right now, I can lend my Bitcoin out to a variety of different platforms and get a 6% yield. Now, is a yield that important when a thing is really volatile, goes up and down a lot? Yes and no, but gold investors, they like to have their cash flows as well as having their hard assets. So Bitcoin takes a little bit of that away because you have a superior asset. Let's just call it that. And Bitcoin, due to easier transportation and the way that you can use it, is much more easy to collateralize as well. So one of the other headlines I didn't cover this week is that Coinbase has come out and said, look, if you have Bitcoin and you don't want to sell it, you don't want to accrue capital gains from selling it at a profit, you can lend your Bitcoin out. We'll let you borrow up to maybe 30 to 40% of the value of your Bitcoin, and you can have that in cash and then pay us 8% interest. And if you do that, we give you your over-collateralized Bitcoin back. So these are very highly collateralized loans that you can now do anywhere, anytime with Bitcoin. And they didn't have to go through regulators to get this done, and anyone in any country can do this at any time. And Coinbase is not the only person doing this as well. And so I imagine for a lot of the people that have bought Bitcoin today that are content on not selling it ever, in the future, when these people want to build and do things, as long as they have a way of creating income for themselves, they're just going to loan out their Bitcoin. And they might go their entire lives without ever selling their Bitcoin. As long as Bitcoin's around, as long as it's on its trajectory that it's kept on, why bother selling it when you can just collateralize it and get something done with it? And especially over collateralize it, because again, if you even just take out 25% of the loan value of your Bitcoin, Bitcoin has to drop 75% before the person that's holding onto your Bitcoin as collateral starts to get worried. And that just historically is not as likely to happen anymore as it was maybe back in 2011 or 2012. So, okay, let's get to the final point here. Can Bitcoin actually help reduce the monetary premium of housing? Because we talked a lot about gold, we talked a lot about Bitcoin, but can it help you get cheaper real estate? Is there hope for the future of people looking to get real estate because of Bitcoin? And do you have to own it to take advantage of that? Well, the answer is a little bit complicated, but here's kind of what I've come up to. So we know that housing is used as a store of value, but it's got a lot of other aspects to it that make it a little bit complex. One is that it can be seized. Housing can be seized by governments if they change. Laws can change, and so your property rights are only so good as the promise your government makes to withhold them or uphold them. There's also tertiary taxes, and there's depreciation on houses too. So while housing does inflate with the housing market, sometimes the value of your materials will go down, or you'll have really absurd property taxes depending on where you are, and that has to be taken into consideration when you consider the value of your house. So it might be going up 15% a year, but maybe you're paying 2 or 3 or 4% property taxes per year. So really, you're only getting about 10% a year or so. And when your property taxes accrue, you can't just take that out of the value of your house so easily. You could maybe apply for more mortgages, but if you have $1 million house, end of the year you got a 4% property tax to pay. You got to come up with $40,000 from somewhere. And so if you're not liquid and the house is your main asset and you don't have your $40,000, then it's a bit more of a liability than anything, I would say. And then there's maintenance costs as well, upkeep. Any homeowner can tell you that. And if you're especially buying overseas, you don't know all the things that could potentially be going wrong with your house at any given moment. So the question is, okay, so these are all these problems. We know that Bitcoin's this good store of value. It's done amazingly, 150% compound annual growth rate. Why isn't everyone just using Bitcoin for a store of value right now? Well, we know that there's regulatory issues. Some companies can't invest in it. Some countries don't let you invest in it. There's still a stigma and a lack of understanding of what the asset class is all about. A lot of people still look at it like this speculative thing. Most people watching this show right now probably thinking, I'm only in Bitcoin because I want to make more money, even though I think that Bitcoin is money. And then older investors are used to an old paradigm. They don't want to buy these things like cryptocurrencies because they don't produce cash flows that are, obviously transparent. And a lot of them, I think if Warren Buffett knew that you could lend out your Bitcoin for 6% a year, he might change his thesis a little bit about it, maybe. But a lot of investors look at it and say, look, no intrinsic value. We don't know what it's back like. We don't know how to value this thing. Therefore, we're not going to put any allocation into it. In my opinion, I think that this stigma will erode over the next few years. I think that at what degree, it's impossible to predict. But I think that as people start to see Bitcoin as an asset class that they have to have in their portfolio, it takes away from every other asset class that people view as a store of value or a hedge against inflation. If they are seeing an asset that is outperforming, and for the last 4 years, Bitcoin has been the best performing asset, and every year it's getting easier and easier to purchase that asset, and every year the stigma of buying it goes down gradually, I think it is only a matter of time before everyone says we got to get a 1 to 10 to whatever percent allocation in it. And so I don't agree with all the math here, but Greg Foss, who's a big bond guy, he was on a Twitter Spaces with Michael Saylor, who is the MicroStrategy CEO, wants to own all the Bitcoin in the world, and he said that he has his estimation of the market share that Bitcoin can capture, and this is some of his math. So he thinks that Bitcoin can capture 40% of gold's $13 trillion addressable market cap. That one seems to be the easiest thing for me to comprehend. I do think that younger generations, and you can't rule this out, are looking at Bitcoin and they're saying it's gold, it's digital gold. Some people even think that Bitcoin's like a boomer coin, that it's only lame old guys own Bitcoin now. But we see that Bitcoin has already captured 5 to 10% of gold's market cap. It doesn't make sense that it just stops there. It can go even higher. And so if we capture 40% of gold's market cap, Bitcoin goes to $200,000 a coin, right? So if it gets to $5 trillion market cap, it's eating about 40% of gold's addressable market, gets to $5 trillion a coin. But it doesn't stop there. He thinks that it can replace some of the money that people put into cars and collectibles. I don't really know about that. I don't know if people put collectibles and rare art as a specific allocation percentage in their portfolio, but he thinks it can take about 10% of that, and maybe that's another $500 billion. Fine art, again, 20%, and I'm not really sure. I think a lot of investors can go without owning collectibles or fine art, but I'd love to hear from you guys personally. Do you look at any collectibles or art or NFTs that you have as a percentage of your net worth? If you do, tell me in the chat. If you know anyone else that does, tell me. I don't look at those things. I don't consider the value of them. I would maybe only consider the value of them if I was, down to my last penny and I needed some extra cash to live. But I don't look at the appreciation of a piece of art that I have, and that's specifically because it's not really that liquid. I can't just sell a piece of art like I can sell a house or a stock or a Bitcoin. There's a very specific buyer for a collectible. Some collectibles are more liquid than others, but my point still stands. Real estate, and now this is one of the biggest kahunas. He thinks is about $228 trillion asset class, and Bitcoin can capture 20% of that. Now, I would say that number is a little bit high. That would basically mean that Bitcoin can erode the monetary premium of housing by about 20%, which is a lot. And I would say, that would probably take years to do. It would have to become a nationalized currency in a lot of places, I imagine, before anybody seriously took Bitcoin under consideration as something that could upend real estate. You'd want to see a country look at it as something in their strategic reserves, similar to El Salvador. But if it did that much, 45 trillion, that takes Bitcoin multitudes higher than it is today. The stock market, he believes that it can capture about 20%. To give you some insight, I don't know what the total value is of all stocks in the US, but if you look in the S&P 5 index specifically, the top 5 or 10 companies in there make up 40 or so percent of the entire index. So you're talking about Tesla, Google, Amazon. They make up such a massive percent of the US economy, just those 5 or 6 companies. You take those away, you're taking a massive chunk out. And so he believes that Bitcoin can capture a chunk of that as well. 20% seems a little bit high to me, but who knows? The big one is negative yielding bonds. I'm not a big bond expert, but the thought process there, and sorry if my little icon is covering this up, the thought process there is essentially that there's a whole bunch of bonds right now that yield nothing or negative, and there's no point in owning them. But people have these mandates, and fund managers are told through generations that you have to own bonds, you have to own bonds, you have to own bonds. I don't think it's necessary anymore. And I think people are going to wake up to that. They can only have so much money siphoned off from them before they say, look, we got to get rid of these things. And so if people start dumping bonds, it's not a good look for the governments, because they need someone to pick up the slack so they can issue more debt. So there's this untold agreement between governments and investors that someone's got to pick up the bonds, because if you don't pick up the bonds, I don't know how we're going to pay for anything. And then there's low yielding bonds, and those still exist, and he thinks that they can take about 50%. The point being this, is that Bitcoin, you can look at it like this black hole. And I think the obvious thing that it's draining from right now is gold. If anybody has a counter argument to that, I'd love to hear that. But I'd also love to hear an explanation or an opinion as to why gold has not appreciated anything since the COVID pandemic, really, or it's negative 7% for the year. Everything else is basically up. I'd love to hear the thesis on why gold has underperformed. And if you disagree with me, I'd love to hear that as well. And I think Bitcoin is coming for other things as well. And so here's what happens is we are going through this giant dematerialization of our economy and our lives. So we know that the internet dematerialized a lot of things like information and education. We no longer have to rely on our local governments to provide schooling for us. We can do things online. Maybe they cost a bit of money, maybe they're free. Someone can get a world-class education without stepping foot into a classroom nowadays, and that is just a fact. It's not maybe everyone's learning style per se, but it is what it is, and it is a superior method of teaching people. That cannot be argued, that the information that is available, the infinite amount of information that is getting refined and made better every single day by the internet, is a superior way of learning than going to a public school system. No matter if it's the best public school system in the world, you're not going to get the ease of access, and you're not going to get the best explanations of certain materials from an individual teacher who's going through teaching school. That's just a fact. Now, what that has done is that's freed a lot of people to be location agnostic, and I think this is one of the biggest things that we're getting at with the metaverse and what is going on with Bitcoin is that housing, there's a utility value to housing, which is its location. And people in the future, I think, are not going to be so location dependent. So not only do you have Bitcoin eroding maybe monetary premium, like I might be speculating, but the internet at large is dislocating people. We have digital nomads everywhere. People like to be close to their parents or their family, but things change. And as the people who are not internet savvy unfortunately pass away, and more people have parents who might be digital nomads, this idea of we have to locate at a specific place to be with a specific set of people, it might disintegrate entirely, because you have people who also work jobs online. And that brings me to my last point, is that Bitcoin is dematerializing the need for state money. And so a lot of the reason that people say, I got to get real estate in this country, or I got to get real estate in this place, is because they want to be a part of a country's society. And with that comes the need to use that society's money. But as we move to an era of Bitcoin, where Bitcoin becomes accepted, where I am personally going on a trip to El Salvador, I am not bringing cash. I might bring a little bit to back me up, but I'm going to be likely spending a majority of my transactions there through Bitcoin. If this thing spreads like a virus, you are going to be able to have non-state money in almost any country you can think of. And what that allows you to do is it allows you to work from anywhere for everyone anytime. And that basically means that the government's control over you and what you do and where you live, the grip loosens and loosens and loosens. And frankly, my whole opinion about the politics of what's going on with COVID, I have my opinions and I'm not going to yammer them all to you, is that these things, whether they're mandates, whether they're rules, whether they're cancel culture, it's the last dying breath of the last 100,000 years of how we have structured society, because we are moving to a world where decentralization is just going to be better. We've seen what happens in the free market when you introduce something that is frictionless, that is better. People gravitate towards things that are material improvements in technology. Bitcoin is a material improvement in the technology of money. And there are people who are fighting that because they know that with that improvement comes lack of control from a state or central authority. That's what the entire decentralization movement is about. So I think everything that's going on, you have people enacting tyranny and people, fighting against it and doing, really crazy things right now. But I think we are on a path of inevitability to having Bitcoin as a stateless money that everyone acknowledges. And you might not acknowledge it right now. You might look at it as just your inflation hedge, but in my opinion, we don't get to $1 trillion and then see this thing fizzle out. We will begin to see expanding decentralization of Bitcoin. It won't just be the USA mining, it won't just be China, it'll be all sorts of countries. And these countries will work together and they will recognize the benefits that the currency brings. They will sacrifice some of their power over their people to have a better standard of living and happiness. And I really think that the power dynamics of the Western world are going to change entirely because of it. And that will only spread to every other country on Earth. And that is it. When it comes to housing, monetary premiums will eventually erode because eventually one day it just won't matter where we live. In the meantime, if you buy Bitcoin, I still think you're early. And you know what? It has given me a much better shot at owning a house than anything else that I've ever done in my life. I've started a business. I've invested in other things. Just buying and holding Bitcoin has gotten me so much closer to home ownership than anything else I can think of. And I don't recommend that as an investment. I just recommend that as a way of looking at money a little bit differently. The cost of a house in Bitcoin has gone down every single year. When you change your mindset and when you change the way that you look at things like that, then it unlocks a world of possibilities. That's it. That's all I have to say today. All right, let's jump into the chat here and see what people think. Oh yeah, brief thing too, and this is going a little bit long, but hopefully you guys like my little tangent on all of this. I do some day trading every now and then. So if you aren't in the Discord and you want to know what I'm trading, I try and be pretty clear with what I trade, and I'll tell you if I take a loss on something, and I'll tell you if I make money on something. But I will go through charts, and sometimes I find these really interesting setups on cryptocurrencies or stocks, and I will say, look, I'm entering at this price, or I'd like it at this price, and I would exit if it dropped below this price, and I would try and take profit around here. We had a couple that worked out the other day. I'll try and share them as often as I can. I sometimes do these small time frame trades, but if you want to follow along, you trust me, you want to lose some money with me, you want to make some money with me, join the Discord, check out hashtag altcoins or hashtag stocks, and I'll try and post some things that I think are optimal setups. And you guys are also welcome to share the same things as well. If you post something amazing, I might take the trade as well. But yeah, that is everything. Yeah, let's go into the comments here. So Ben Gardner. Alrighty, so very interesting points. Are there cybersecurity costs or even the cost to secure electricity in some areas? So this is a good point, and this is why I don't look at the article here as gospel. It's not like Bitcoin doesn't need some military or rule of law to secure it. It does need to have steady sources of electricity, right? So you need to have, a sovereign source of electricity. Some people mine or uphold the Bitcoin network through the grid. So you're buying electricity from the grid at a set fixed rate to mine Bitcoin. However, it's not exclusive to that. You can go to any country, and in my opinion, the best source of electricity for Bitcoin is a waterfall, is hydroelectric, because it's constant, usually year round. And you might not even need permission to do that. Or you have people who are doing this way out in the middle of nowhere, and so that way you don't really have to worry so much about the state coming in and saying you can't do this here or do that there. I think countries are going to try and make legislation around, can you mine Bitcoin with this or that? They don't want people using coal. But so many people in the Bitcoin space are using renewable energy. And now that Bitcoin has moved to the US, a lot more people are using renewable energy sources there, as opposed to China, where they were using a lot of coal to mine Bitcoin as well. And there are some cybersecurity costs. You have to obviously have physical defense at these mining locations, or else someone can come in and shut everything off. So it's not to say that eventually all of these things will not need any military or rule of law, but the amount of military and rule of law needed to defend land, gold, oil, equities is going to be much more than what is needed to defend the Bitcoin network. And that's where the monetary premium erodes. It's not a complete absolving of it, but it is a lowering of it. And not having to waste that human life, again, makes it more valuable than all the human life that is lost to protect gold, oil, real estate, things like that. Gold last year was doing great when COVID really created massive uncertainties. Yeah, so I think gold was doing okay. I know that there was a liquidity crunch in March of 2020 and everything dropped, everything, Bitcoin, gold, everything, except for Netflix. Netflix was like the only thing that didn't drop during the March panic. But I don't know what it's done since. All I know is that anything else has done better. That's not to say gold isn't cool. I own a little bit of gold. Gold's fun. It's nice to look at. There's a physicality to it that I don't have with Bitcoin that, maybe someone will replicate one day. Somebody will make like a Bitcoin thing, maybe like a tungsten cube with a B in it that'll replicate the physicality of holding a Bitcoin. I want a tungsten cube. Those things are so dense, man. I was reading that somebody had like a 14-inch tungsten cube. I don't know what that is, like a size of a ruler, and it was like 200 pounds or 2,000 pounds. I can't imagine it was 2,000 pounds. A 14-inch tungsten cube, but just like, you got a tungsten cube about like this size, and it's about the size of a house. Or it weighs, it weighs about as much as a car because it's so dense. But, yeah. Mikiko, I think art can be considered a part of your net worth. Just like gold and jewelry, some art can be just as valuable. But yeah, it's not as easy to store or sell to the market like Bitcoin. Yeah, it's another good point too, is that art really needs to be protected. Like, really needs to be protected. Like, you can display it in your home, fine art, but art is so fragile in that sense. Like, I can, if I have a brick of gold and I drop it in transport, like, it's not like all is lost. Maybe it's dented up a little bit. But art is one of those things where you do have to take enormous care and sometimes pay a lot of money to secure them. That's why there's a whole genre of movies which is just like protect the Hope Diamond or protect the Mona Lisa or national treasure, right? Like, people pay a lot of money to protect art because as soon as it is, even if it is the only one on earth, if it's damaged, so much value is lost instantly. And then the liquidity is also really hard too, because let's just say you own a Da Vinci you paid $60 million for, or a Beeple you paid $60 million for. It's like, who's going to buy it next from you? Like, people are not in the market to buy such large things. There's not that liquidity. But one of the interesting things is that I think with tokenization and with cryptocurrencies, people are going to be able to tokenize fine art in some way. So I think, and that's a little bit more complex, but people might be able to take art pieces or real estate or anything really that has value and say, look, we're going to make this into a token. And so if you buy Da Vinci token, you own 1/100,000th of Leonardo da Vinci's painting, and you own the rights to sell that token to anyone else who values it at whatever price. So tokenization is going to bring a lot of liquidity into things that normally didn't have markets. And so I think there's going to be let's just call it like a renaissance with fine art, in the sense that people are going to be able to kind of auction off segments of their fine art as a liquid market. And you'll be able to have like an NFT to verify that you own 1/10 of the Mona Lisa or statue or NFT or whatever. People are already tokenizing NFTs and making NFTs into currencies, which is just like a whole other level of confusing. All right. What else? Bitcoin versus Ethereum smart contracts, Internet V2. I think this will be more valuable in the end. Your thoughts about Ethereum? Okay, so I first got into Ethereum before I got into Bitcoin. Ethereum was like my first cryptocurrency, and I felt that I understood the potential of that in the beginning, which is that we can have contracts that basically settle things where trust is needed by a third party, and that third party is not doing an adequate job. Either they're not that trustworthy or they're costing an exorbitant amount, and Ethereum can provide finality in this regard. My opinion on that has changed a little bit, because I think a lot of the value of smart contracts comes from the security of ownership of something or another thing. But the problem is that Ethereum's monetary policy right now, in my opinion, is not sustainable. The way that we're burning Ethereum up, it's good for the price of Ethereum. It drives, you have this asset that is not really finite, but it's actually deflationary right now. And so an ether is getting harder and harder to come by every single day. And that might be really cool for people who own Ethereum, but for people who actually want to transact on the network, it's the opposite way around. And so part of the problem is that as the price of ether rises, it makes the accessibility of that network and the utility of that internet V2 or V3 a lot harder for everyone else. And so, example, like a very basic example right now is that if I wanted to mint an NFT on Ethereum, I got to pay thousands and thousands of dollars. And what is this doing? It's gatekeeping people who are just small-time artists from entering and providing value. And so all of these things, I believe, have network effects. And so if you start putting up these gates of affordability, like person can't participate in your network and they can't provide value because the gas fees are too high for people, then your network starts to kind of curve off. And so I don't really have the empirical data to prove that the Ethereum network is slowing down because of gas fees or it's not getting as much usage. It's probably not. It's probably gaining in usage. But what that does is it incentivizes people that still want that Internet 3, that V3, to look at other platforms like Solana and AVAX and things like that. And I think that's why this year, while Ethereum has done really well, it's up twice as much as Bitcoin, Solana, AVAX, Cardano, all of these other V3 internets have just vastly outperformed it. And I also don't think that it's going to be a zero-sum thing. I think there's going to be different networks for different things. There's going to be a huge market in making these networks bridge and be intercompatible with one another. But I don't know if Ethereum is cemented as the number one player forever. I look at it like a foundational technology, but it hasn't rooted itself that well, and that's just because of the predictability of it. And I think that other V3 smart contract platforms can come around and do a better job than Ethereum is doing. And so, I don't know. I'm not selling my Ethereum, but I look at a lot of the other assets, and I've taken some of my Ethereum and said, look, I think you can look at it like a basket. I don't think you can look at Bitcoin like a basket. I don't think there's any other asset that's quite like Bitcoin. You can own Bitcoin and gold maybe, but there's no other cryptocurrency that is doing the store value thing like Bitcoin is. But there are a lot of other cryptocurrencies doing the same thing that Ethereum is. And Ethereum might win out at the end. ETH 2.0 might solve all of these problems. And then you know what? The best short will be Solana and AVAX and all these things. If Ethereum does a 180 and makes everything really accessible, then we don't need all the other cryptocurrencies that are doing the same thing. If you can just do it the best. But I do think all of these ones have different trade-offs. Some are faster than others, cheaper fees. Some are more expensive, more fees. Some have more staking rewards. That's why you see not just like one Ethereum competitor, but there's like 5 or 6 different ones. People are willing to sacrifice one thing for another. And eventually, I think it just comes down to the user base and the growth between all of them. I think Luna is one too. I haven't even dived into that one. But yeah, that's about it. I gotta head out, you guys, but thanks so much for watching. I hope you enjoyed it. I think this is one of my favorite ones I've done so far. I hope you learned something. And yeah, let me know if you agree with me on all this. Maybe I've just gone too far down the rabbit hole. I've listened to too many men in their 40s and 50s tell me about how amazing Bitcoin is, and then a bunch of Gen Zers who are like 18, 20 tell me about how amazing it is. Maybe I've just taken too much in lately. Maybe I've gone off the deep end. But I do think that Bitcoin can really solve the way that we look at monetary premiums on things, and it can change the allocation of store of value capital that has persisted so long in things like housing and equities and gold. But yeah, thanks so much for watching. Take care, and I'll see you in the next one.